So as normal, as always, please
Yep.
read the information and get back to me. Anything that we need to consider, please.
Refurb Limited recycles golf balls. The company has two director shareholders, Mr. Cotton and Mr. Banks, who each own 50% of the issued ordinary share capital. My instant thought is possibly a close company, as there's
Yes,
two shareholders who own 50% each of the company.
definitely a close company. Less than 5 participators, so it's definitely a close company. Good.
The company's accounts for the year ended 30th of June 2021 show a trading loss of £250,000 as adjusted for corporation tax purposes but before capital allowances. The company's corporation tax profit and losses.
I just wanted to ask a question. Refurb Limited recycles golf balls. What does that tell us?
A trading company or no?
Trading company, exactly.
Trading company.
It's a trading company. So these are things that may not be sort of too relevant on the face of it, but it's good to have this background knowledge in your head.
What if it's not a trading company? What would that affect? If it was a trading company, what would that?
Well, trading company is important for a good few reasons. One is business asset disposal relief.
Yep.
If you're disposing of shares in a trading company, then 10% is available. If not, it's not available. Gift relief as well, business assets or trading assets, company purchase of own shares as well, which is that it must be an unquoted trading company. And the other thing that I can think of is BPR for inheritance tax purposes. It must be a trade company.
Okay.
So there's many reasons why trading is very important. Sorry, and another question. What are your thoughts on whether a company is trading or not? So, you know, the substantial trading test, the 80-20 test.
Oh, yeah. There was something about whether is it 20% of or 20% or more of the profits come from other than non-trading would make it a non-trading company in HMRC's eyes.
Not profit. There's three indicators. So if more than 20% of assets on the balance sheet are for non-trading purposes, or more than 20% of turnover is related to non-trading, not profit, turnover. And if more than 20% of time or expenses are spent on non-trading activities, then this will point towards a non-trading company under the guidance of HMRC. Why? Because the legislation just states that to a substantial extent, it must be a trading company to a substantial extent. So HMRC go on to define what they understand as substantial extent. Not one test being met is conclusive. So it doesn't mean if your assets on your balance sheet 50% are for non-trading activities, it does not mean that, okay, it's definitely a non-trading company. You have to look at the whole picture. Same as IR35 and the tests, mutuality of obligation, control, and the rest of it. You look at the whole picture. Not one test is conclusive.
Okay, thank you.
We have a trading loss of 250,000 before capital allowances. So that tells me that we'll probably have to work out some capital allowances.
So the company's corporation tax profit and losses after capital allowances for the 3 previous years were 100,000 profit at 30th of June 2020, 30th of June 2019 a loss of £60,000, and 30th of June 2018 a profit of £10,000. My instant thought for that would be that we could possibly use that trading loss of £250,000 against these years. How we would use it depends on whether, if there's any information about it being a new company, being closed at any point, or just use the usual like section 64, section 83.
Agreed. Good.
So
read the next paragraph and let me know if your thoughts change, please.
Okay. A claim under section 37(3)(b).
Oh yeah, sorry. You know when you said section 64, section 83, that's for individuals.
Okay.
Companies is 37.
Different.
Yeah, 37 CTA 2010 is current year, previous year, and 45 is carried forward.
Sorry, I'm just trying to find that in the memory jogger, so I have it with me. Okay, yeah. Okay, so they can, okay. So a claim under Section 37 was made for £10,000 for the loss for the year ended 30th of June 2019, so to be set against the profit of the previous year, and the balance of £50,000 was carried forward against the profit for the year ended 30th of June 2020 under Section 45.
Mhm.
So they've done a current year claim under Section 37.
Previous year. So the
Previous year.
60,000 loss here has gone back to the
Okay.
10,000. So a claim under Section 37 was made for the
Okay.
10,000 of the loss of 60,000 to be offset against the previous year here. And the
Okay.
balance of 50,000, because you've used 10,000 down here, so 50,000 you carry forward against the 100,000, so that is reduced to
Okay.
50,000.
Right. Okay. So they've used up all that loss.
Agreed. Yep, that loss has been utilized. Good.
Okay. So in that case, they've only got £50,000 of profit left in 2020 and nothing in 2018, if I'm correct.
Agreed. Yes.
Okay. So contracts for the sale of the company's trading premises were exchanged on 15th of October 2021, with completion expected on 30th of November 2021 with Refurb Limited, when Refurb Limited will cease to trade. The company's corporation tax profit for the final period is estimated to be zero before capital allowances and estimated closure costs of 35,000 for statutory redundancy payments and 45,000 for impaired trade debts. We would consider Section 39 terminal loss relief in this case at 30th of November 2021.
Agreed. That will be considered.
So this is where the trading loss of the final 12 months, so it'd be that year ended till 30th of November 2021, can be carried back against total profits of the 36 months ended immediately before the loss-making period, rather than the normal 12 months of carryback. Okay.
So we have effectively, but we have a loss for the year ended 30 June 2021.
2021, yep. And then we didn't cease to trade till 30th November 2021.
Exactly. So that all needs to be considered. We'll do some calculations
Okay.
in a bit, but that's good to consider. The company's corporation tax profit for the final period, which is how many months are we talking? We're talking July, August, September, October, November, 5 months to 30th November 2021. They'll cease to trade, and the profit is zero. But this is before capital allowances and closure costs of 35,000 and 45,000. Now, these 35,000, 45,000 individually, please let me know if they are allowable or not.
I think statutory redundancy payments are allowable, but there is a ruling on how and what. So it's a maximum 4 times statutory redundancy payments on the cessation of trade.
So we'll say that's allowable.
Yep, and the impaired trade debts.
Yep.
I would say they were allowable.
Okay, why?
I'm assuming that trade debts that have been impaired. Oh.
Yeah, it's relating to trade.
Yeah, so it should be allowable.
Exactly, it's wholly exclusively for trade purposes. The debt was for trade, and now it's been impaired. It's an allowable expense, allowable deduction.
Yeah.
Okay. And it's before capital allowances. So again, I'm thinking we'll need to work out some capital allowances.
Yeah. During December 2021, the directors will continue to collect trade debts and pay creditors prior to the appointment of a liquidator after the Christmas and New Year holiday, to take effect on 7th of Jan 2022. The liquidator's fees are expected to be £20,000 for a member's voluntary liquidation.
Okay, my first question is, liquidators' fees, are they an allowable expense or not?
Oh. I want to say yes,
What's your basis?
because isn't this like kind of part of the trade and like I'm not entirely sure to be fair about this.
No, you can't say it's part of trade because this is to close the trade down. So it's
Right.
more from the outside. The liquidator's fees is not to do with, it's not in the trade. It's not anything to do with recycling golf
Yeah.
balls.
Right.
It's outside the trade, so therefore it'll always be disallowable. So just keep that in mind for any future questions. Liquidator's fees will never be allowable.
Okay.
In terms of the directors will continue to collect trade debts and pay creditors,
Mm-hmm.
and the liquidator will be appointed on 7th Jan 2022. What can you tell me in regards to accounting periods for companies?
Okay, so accounting periods for companies can be long accounting periods, but for I think capital allowances purposes and general purposes, we're only allowed maximum of 12 months. So we'd kind of had 2 if it was a long period.
Good.
So in this case, would it start from 1st of July 2021 till 7th of January 2022?
It'll be so the first one will be from 1st of July 2021, which is after the
Yeah.
end of the last year, up until 30th November 2021.
Okay.
And then you'll have 1st of December 2021 to
Okay.
6th of Jan 2022. Why? Because according to corporation tax accounting period rules,
Okay.
the appointment of a liquidator would be the start of a new accounting period. So then you'll have 7th of Jan 2022
Oh,
up
okay.
until liquidation completes, or 12 months.
Okay, got you.
Keep that one in mind.
Yep, I'm like finding all these little points in the memory jogger.
Yes. Yep.
Perfect.
Okay. Continue, please.
The sale price for the traded premises is £750,000, giving rise to a capital gain of £300,000 after the deduction of indexation allowance. An election under Section 198 has been entered into with the purchaser of the building, which places a value of £1 on all fixtures in the building. Okay, so that will be relevant towards our capital allowances, because when we bring that fixtures into our capital allowances, we'd value it at £1. Does it matter that they've told us about a capital gain of £300,000 or?
Yes, the £300,000
or
would be subject to corporation tax, right?
okay, yeah.
Because
Is
when
there any
receiving,
for companies? Is there any way that they can set losses against capital gains like you can in individuals?
you can't.
I think individuals is not section 72 or something.
Yeah, exactly. Yeah, after current year, previous year, you can extend to capital gains. For companies, current year gains, net gains of the current year can be offset against total profits, or trading profits. But you can't, in this case, it's not really possible, because we've just got this loss cannot be carried back. So for capital losses cannot be carried back. So, but we have a capital gain anyway. So, so it's a gain here anyway. So,
okay. The company remains solvent despite current losses, and there will be a balance of funds to distribute to the shareholders. The company's assets include cash of £300,000 and a loan to Mr. Cotton of £100,000, in respect of which company paid tax under Section 455 of £32,000, £32,500. So my question on that would be, they've given it's a loan to a shareholder within a close company. So would we need to kind of figure out whether that loan has now been written off or whether Mr. Cotton has paid it off? that would
Exactly.
differ to whether they'd get that Section 455 back at the date of cessation.
Yeah, it won't be exactly at the day of cessation. It'll be 9 months and 1 day after.
9 months and 1 day.
After the accounting period in which it is repaid. But yes, your thinking is right. The company's assets includes cash of 300,000 and a loan to Mr. Cotton of £100,000. So what that means is Mr. Cotton owes the company £100,000. Now, when you are ceasing trade and you have a members voluntary liquidation, as we have here, you'd want to go for the capital treatment. So you'd want the cash proceeds to be distributed and get the capital treatment. Now, let's just say, obviously, you'll have 300,000, but then you also have this proceeds here, which needs to be distributed as well, because the trading premises will be sold, and we'll have £750,000 cash then on the balance sheet as well. So anyway, what I'm trying to say is all this cash needs to be distributed to Mr. Cotton and Mr. Banks. Okay. Now, Mr. Cotton owes the company £100,000. So there's a question here, and it's a common question I've seen a few times come up in exams. Is ignore the 750,000. Let's just say 300,000 is to be distributed between Mr. Cotton and Mr. Banks, £150,000 each.
Okay, yeah.
Do we write off the loan of £100,000, or do we write off the loan of £100,000 and give Mr. Cotton £50,000 from his 150? Does that make sense?
Yeah.
Or do we give him the full £150,000 and then he repays the loan?
Yeah.
And that leaves him with cash, net cash of £50,000.
£50,000, right.
Now, what are your thoughts initially?
So if he continues, I'm just thinking, if he continues to have that £100,000, how often would the company still need to pay that Section 455 penalty charge? Is it just the once?
No, as in that's already been paid.
Okay.
Now, once we either write it off or Mr. Cotton repays the loan, that 3,500 will be repaid from HMRC. So so what we're trying to say is, should we write off the loan of 100,000, or should Mr. Cotton repay the loan? And the answer is Mr. Cotton should repay the loan. Why? Because if you write off the loan, it will be treated as a dividend distribution, correct?
Yeah.
It won't be deductible for the company.
Yeah.
And national insurance contributions will be required.
And that's only on the write-off?
Only on the write-off.
So if he repays the loan, what happens?
If he repays the loan, nothing happens. The only thing is that when they pay him the 150,000 from the liquidation, he'll be subject to capital gains tax on the 150,000, and then he'll repay the loan. So you'd rather be subject to 10% with BADR rather than income distribution of potentially 38.1 and class 1 NBC. So he'll get the cash from the company as a distribution, capital distribution, and then he'll repay the amount normally, which will still leave him with net cash of 50,000, but he would have avoided NICs and dividend tax rates compared to 10%.
Got you.
198 election, just re-enlighten me, please, on what this constitutes.
It's either the fixed value requirement. Is that the one that we're talking about?
Yeah, but there's two. There's the fixed value requirement
and the pooling requirement.
Okay, so explain the two.
So fixed value requirement is where the purchaser and the seller have to kind of agree on the value of the fixtures, and I think it's just on the fixtures.
Yep.
So if doing so, they can kind of use that figure going forward. So for the seller, it would be a disposal on their capital allowances, and for the purchaser, it'd be an addition on the capital allowances, but at the same price. And then the pooling requirement is where I feel like the seller should have previously pooled the fixtures into, like, it should have pooled the fixtures so that the buyer is then able to pool the fixtures in the same category and claim capital allowances.
Exactly. So the main thing is that the seller should have claimed capital allowances.
Okay.
Which means they should have pooled the items. Excellent. Very good. Any questions so far?
Nope, all good.
Let's continue, please.
The company's capital allowances computation for the year ended 30th of June 2020 shows a balance of qualifying expenditure on the main pool of £250,000, except for the disposal of the property. There has been no additions or disposals of plant and machinery since 30th of June 2020. The company's fixed asset register includes 2 commercial vehicles, miscellaneous office equipment, and a specialist production plant which are expected to be sold below the cost of each item, for a total of £100,000 during the course of liquidation. The thing that jumps out at me at that point is, well, at the end cessation of a company, they're not entitled to any AIA, WDA, or FYA. Is that correct?
100% correct. Good.
It's just capital charges and capital allowances. So the fact that they're selling this production plant below the cost of each item, they would have capital allowances.
Balancing allowances, right?
Balancing allowances, yeah, sorry. Yeah, that's the one.
Yep. Yeah,
So
so
they'd have
yeah,
a
it's
balancing
capital,
allowance.
but but on cessation, you treat it as some sort of balancing allowance.
Yeah, sorry, that's what I meant, yeah. So they'd have so we'd need to know the cost of that item, but they'd have a balancing allowance in on that.
Yeah, so it says here, the company's capital allowances computation for the year ended 30 June 2020. So we're going back a bit.
Yeah.
On the main pool was 250,000.
Okay.
Now
So
remember, this loss of 250,000 is before capital allowances. So our brought forward would be 250,000 on the capital allowances pool. Yeah, and then we'll just take it from there. Basically, we'll have the £1 election.
Yes.
And we'll have a disposal proceed figure of 100,000 as well. We'll do the calculation shortly.
Okay.
Yes.
So Refurb Limited also owns a flat which was let on short assured tenancies, but has been vacant since 1st of July 2020. The property was purchased several years ago, is now valued at £200,000. Again, after indexation of £100,000 will arise on the disposal of the property. Mr. Banks would, however, like to acquire the property from the company to retain as an investment. Property was purchased. And for gains, there's a separate tax on residential property, but then this was. Would this be class?
Yeah, the limited company owns the flat, so it'll be corporation tax at 19%.
Okay.
We have a gain of 100,000 on the disposal, so that will be subject to corporation tax.
Okay.
Mr. Banks would like to, however, acquire the property from the company to retain as an investment.
I'm not sure.
Okay, that's fine. So what would probably say is the timing is important, because you'd want Mr. Banks to acquire in the period to 30th November 2021, so that any losses can be utilized.
Okay.
Against this gain of £100,000, because we've got quite a few losses that we need to make up for. And if you realize this gain now, then we can use the losses against this gain. Okay?
Makes sense, yeah.
Because any unused losses or unutilized losses cannot be carried forward. Why? Because we're ceasing trade.
Yeah.
After cessation of trade, no carry forward.
Okay.
Yeah. Okay. So requirement: discuss the corporation tax implications of the above information, including any proactive advice which may be given. So this is quite important. You have to think outside the box, and we need to explain the corporation tax implications. I will do bullet point format on Word, and then we'll do
Perfect.
some calculations on Excel. Okay, so the first thing to consider, we need to discuss the corporation tax implications of the above information. I would probably start with the accounting periods because that's the administrative side of things. So talk me, have you got the question up in front of you as well or not?
Yeah, I'm just getting it up now.
So corporation tax accounting periods. We have year ended 30th June 2021. I'm just going to do bullet point format. So you'll obviously in the exam, you'd sort of explain it a bit more. We have 5 months to 13 November 2021. Then we have 1 December 2021 to 6 Jan 2022, a day before appointment of liquidator. And then we have 7 Jan 2022, as per the information in the question, either to completion of liquidation or 12 months, which is 7 Jan 2023. Why? The appointment of a liquidator is the start of a new AP for CT purposes. Is that clear?
Yep.
In terms of marks, you'll probably get 2 marks for just identifying these accounting periods.
Okay.
So it's not too bad. The next thing that I would probably speak about is the fact that only 50,000 of 2020 losses available. Of profit available to utilize against losses. And I'll just show you how that is the case. Can you see my Excel now?
Yeah.
So we said, I'm just going to put these in format. So I'll say 30, say 2018, 19, 2020, 2021. So we said profit, there was 10,000 in 2018, there was nothing in 2019. We had a 60,000 loss rather. 2020 was 100,000, nothing in 2021, rather we had a loss of 250,000 before after allowances. And then they said that for the 60,000, 10,000 was offset. So we have section 37 minus 10,000. And we have section 45 carried forward. The balance of the 60,000 was carried forward against the 100,000. Is that all clear?
Yeah.
That's the other point you can make, and you'd probably get, you would get about, you'd probably get a mark for just understanding that, at least half a mark.
Okay.
Okay. Okay, then we need to work out the actual loss for the year ended 30th June 2021, because it shows 250,000. However, this is before capital allowances.
Mm.
So what are your thoughts in respect of capital allowances?
Okay, so our just got the question up. So our tax rated down value would be £250,000 in the main pool, and then we'd have the additions of £1 in the main pool again.
No, the addition,
No.
it's not an addition, it's a disposal.
The £1 fixtures. Okay.
Yes. The £1 fixtures would be a disposal because we're
the one
getting rid
selling.
of, exactly, and then for the purchases it would be £1 addition.
Okay.
But you have to remember, we're looking at the year ended 30 June 2021. This is 30th November 2021. So before that, we need to look at 30th June 2021 over here. So that would simply be, you have the expenditure on main pool carried forward 250,000 at the end of the previous year. So it's simply 250,000 at 18%. Because we're only looking at capital allowances up until 30th June 2021. We haven't ceased to trade yet.
Okay.
Cessation of trade is 30th November 2021. That's when you have the balancing allowances. But for now, we simply do.
Okay, makes sense. And that will get us up till the 30th of June 2021.
Exactly. And then we'll have to do another computation, which we'll do very shortly.
Okay.
But for now, I can say that our 30 June 2021 is therefore a loss before CA is 250,000. Allowances are minus 45,000. That gives me minus 295,000. So we can change this now to 295,000. 295,000 we need to relieve as much as possible against our other profits and gains that we've seen in the question.
Okay.
Are you following so far?
Yeah.
This is back to the question. We then need to work out the period to 30th November 2021, right?
Yep.
Taking into account these closure costs of 35.45 and capital allowances again. So we can do that here. We can say 5 months to 30 November 2021. Okay, so what do we have here? We can say our tax written down value is 205,000. Now this is where we take the £1 disposal and the which other figure?
The chargeable allowance of £100,000. So the disposal of that.
So we have section 198 minus 1. We have disposal proceeds minus 100,000. Gives me capital allowances or balancing allowances. of 104,999. Does that make sense?
Yeah.
We said our profit was 0 as per the
Mhm.
question.
Yeah.
Where does it say? It said profit was 0.
I think it was like,
Companies is estimated to be 0 before capital allowances, which we've just worked out, and these two allowable expenses we said,
yeah.
right? So we have impaired trade debts. We have statutory redundancy pay. Impaired trade debts was 45,000 and 35,000 for these statutory redundancy pay. And capital allowances was the 104,999. That gives us a loss of 184,999. Trading loss 184,999. Now remember, we had a capital gain somewhere.
Yep.
Sale of the trading premises gives rise to a capital gain of 300,000. So we can use that against our trading loss. Gain. So that therefore gives us profit, right?
Yes.
So we got the profit 115,001.
Okay. Okay.
Has that made sense?
Yeah. Just for companies, we don't split out that like we do. Like they don't pay capital gains tax too. They just pay corporation tax of everything.
Exactly. Yeah.
Okay.
Companies will
So-
always pay corporation tax at 19% on everything,
Okay.
whether it's property income, chargeable gain.
We don't kind
Trading.
of split it out the way we do for like trading companies.
What do you mean?
Like we have a capital gains tax computation for like individuals and partnerships. We don't do that here.
Oh yeah. We don't need to do that here.
Okay.
Well, you might have to, but they've given us the gain already. They've told us the gain.
Okay.
So you might have to do 750 less base cost, less indexation allowance to give you the gain.
But you don't need to actually calculate like a tax on that. Apart
Oh,
from
no. It's just added to
Okay.
your corporation tax liability.
Okay,
Yeah.
perfect.
At 19%, it gives you. It's basically part of your taxable total profits. Total includes trading, chargeable gain, and everything.
Okay, perfect.
Now, what else do we have? We have 115,001,
Mm.
and we have a loss of 295,000.
Yes.
So this loss now of 295,000,
Mm-hmm.
we can carry forward and offset against the 115,001, right?
Yeah.
But I can already tell that about 180,000 will be left unrelieved.
Mm-hmm.
So that's why we said that this transaction should happen sooner rather than later.
Right.
So we can give rise to the gain can be realized. So let's just do that here. So let's say gain on property, 100,000. So do you see how we are increasing our profits so then we can use them against the 295 loss? Does that make sense?
Yep. Yep.
And then you'd use against the loss. Let's just remove this. And then loss carried forward is the 295,000. So we'll have loss unrelieved of 79,999 will be your loss unrelieved.
Mm-hmm.
Does that make sense?
Yes.
100% sure. Any questions?
Not at the moment, no.
We started by working our actual loss for 30 June 2021. Then we had our 5 months to November
Yep.
2021, which was down here. We carried forward our capital allowances. We had balancing allowances. Then we had a trading loss offset against our capital gain. And we should realize the gain on the property. Why? Because then we can use more of the losses and less losses will be wasted.
Okay. What about this period between when the liquidator was appointed?
After that, there's no, as in cessation of trade is 30th November 2021, so there's no further action.
Yeah.
Obviously, you'll have post cessation trading, post cessation receipts and expenses, but they have. I don't think they've mentioned anything.
No, nothing. No. So would we just kind of mention about that fee? That it's not really an allowable expense, and it's about the fact that a new account period starts.
Exactly. You can say that Refurb Limited have ceased to trade.
Yeah.
On 30th November 2021. So you may consider post cessation receipts following this date, but obviously nothing's been mentioned, so we can't do anything. Okay, so that's our calculations. Now we still need to come back and explain a few things. So I'm just going to explain these things here first, the closure costs and the 45,000 impaired debts. So I'm going to say impaired trade debts allowable as related to trade, closure costs allowable. It didn't specifically mention statutory redundancy, but closure costs allowable generally or not, but statutory redundancy pay would be under section 77 CTA 2009.
Why is it generally not allowable?
Because it won't be anything, it won't be benefiting the trade, right? So then you can't say it's wholly or exclusively for trade purposes.
Okay.
So if you are
this 4 times statutory payment, what is it 4 times off?
4 times the statutory redundancy pay.
Yeah. So we allowed, what does that mean?
If the statutory redundancy pay was £10,000, you are allowed 40,000 as a deduction.
Okay, so would that apply here as well?
I think you'd probably assume that. That's something that you'd assume, because it just says estimated closure costs. It doesn't. Oh, it does say yeah.
Yeah, of 35,000 for redundancy.
Yeah, it does say for statutory redundancy payment. So therefore, you'd assume that yes, it's allowable.
Okay.
Because if statutory redundancy payments of 35,000, you are typically allowed 35,000 times 4, which is 140,000. So that 35,000 is definitely allowable.
Why am I getting? So we wouldn't work out
4 times. No, we don't need to work out 4 times.
Right. Okay.
It's just saying 4 times that amount is allowable, but they've given the actual amount.
Right.
So that is definitely allowable then. But
how would they word it where we'd have to kind of figure it out?
They may say they may say that 35,000 was for statutory redundancy payments, and a further 60,000, let's say, were for other termination payments.
Okay.
Now that 60,000 falls in there within 4 times, right?
Okay.
Because 35,000 times 4 is 140,000. 60,000 falls within the 140,000.
Okay. Yeah, makes sense.
The liquidators' fees are this allowable do not relate wholly to trade. Any questions with these 3 points?
No, all good so far.
Okay. And then we mentioned that then we can talk about this here. No, sorry, this bit here, the loan of £100,000. So I would say that if the loan is written off or repaid, Section 455 will be repaid by HMRC 9 months, 1 day following the accounting period. It is repaid. Okay? Therefore, the proactive advice would be sort this out, as in repay loan ASAP. So then we can get the refund ASAP, right?
Okay.
Do not write off the loan, rather do not write off the loan, rather pay Mr. Cotton his capital distribution out of cash from the company. So what we're saying is the background to this is Mr. Cotton and Mr. Banks will be receiving is a members' voluntary liquidation, so they will get the capital treatment. So whatever the cash they receive will be subject to the capital treatment at 20%. However, it looks like BADR will be available. So we'll just say here before this, we'll just explain that Mr. C and Mr. Banks capital distribution of cash from company equals 20%. BADR will be available. Why? Because they've held more than 5%. They are directors, and it's been more than 24 months. Okay.
Okay.
Now, what we do here is we do not write off the loan from the company. We pay Mr. Cotton whatever he's entitled to as a capital distribution, which will be subject to him at 10%, and then he repays the loan.
Okay.
Then he repays the loan. We do not write off the loan. Why do we not write off? Because it will be treated as a distribution for Mr. Cotton, subject to 38.1%. Not deductible for the company. Why? Because it's treated as a distribution, right? And also class 1 primary and secondary NICs. Does that make sense?
Yeah.
100% sure?
Yeah.
Okay. So therefore, we would pay him his amount and he would simply repay the money, and the company will then receive a Section 455 repayment of 32,500. Now, I keep saying that he should repay the loan from the capital distribution that he receives. However, capital distribution will only be received once liquidation is complete.
Okay.
Okay. But if there are debtors outstanding, such as this HMRC 32,500, then liquidation cannot be complete, so he can't receive his money.
Yeah.
So what do we do then? The proactive advice would be Mr. Cotton should personally arrange to repay the 100,000 out of his own savings, or even a temporary loan, so that liquidation can complete, and then when he does get his amount, the capital distribution, he can repay this loan.
So if Mr. Cotton didn't repay this loan, can liquidation not be complete?
Well, then they'll just have to write it off.
Okay. Right, I'm with you.
But obviously, we want to avoid that, so that's why we're doing all this.
Yeah.
Yeah.
Okay.
Yeah. Any questions?
No, that makes sense.
Okay. So you'll get a good few marks there, probably about 3 marks. Let me just check. Yeah, about 2 marks you'll get. And it's a 15-mark question, so it's not too bad. The other point we can make is regarding capital allowances. So we did the calculation, so you'll get a few marks there. You can just simply mention what you already mentioned. We can say no AIA, WDA, or FYA in final period up to cessation. What else can we say? We can say that
and we have balancing allowances and charges.
Well, we don't have charges in this.
Oh yeah,
question,
in
right?
this.
We just had a balancing allowance. We'll just relate it to the question. We say balancing allowances. Right, as per calculation. In the exam, you'd probably want to do the calculation first and then explain.
Okay.
We'll say £1 and 100,000 will be treated as disposal proceeds. I think that's fine for capital allowances. As I say, you have the computation, which will get you a few marks, which is this, and then this part as well. And then I think the last thing to consider or discuss is this flat, which we said we should realize the gain sooner rather than later so we can utilize the losses. Why? Because the losses will be wasted on cessation. So what we can say is really bright color. Ideally, would want to realize 100,000 gain before cessation, so we utilize as much losses as possible. If not, losses will be wasted as cannot carry forward after cessation. So advice, proactive advice, sister banks should take out a loan to purchase property ASAP and then can repay the loan from the capital distribution once liquidators distribute. Is that clear?
Yeah.
Any questions whatsoever?
No, all makes sense so far. You know, when I'm doing these questions again in my own time, if I have any questions, am I allowed to like just drop you a message again, just in case something does crop up?
Okay. For general questions, just drop me a message, yes.
Yeah.
And then if
Because
I
my
have
plan
time,
is to kind of go through these again.
of course, definitely.
Yeah.
I'll email everything over to you anyway, so you have that in
Perfect. Yeah.
front of you. But yeah, do drop me a message, and then when I have time, I can get back to you.
Okay. Perfect. But yeah, all makes sense so far.
Yeah, I think that's the question complete.
Okay.
We did the calculations, which will give us a good few marks, and then our explanations will give us a good few marks, and then
Yeah.
you'll get half a mark for presentation and higher skills.
Yeah. I've like highlighted my own question bank as well, just to see where we got points from too.
Okay, good.